Hello and welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems for chapter 9 from the digital study guide. The problem is group B. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And before I jump over to problem 9-49, I can't stress enough that you need to get the underlying concepts. So, go back and watch the theory videos if you don't understand the theory behind bonds. I'm not going to keep going over those basic concepts. I'm going to be focusing more on working the problems than I will be on covering the theory so that you can get up to date for that particular problem. And the reason for that is if you haven't noticed in doing the exercises and then doing the problems, sure, there were a couple of problems that had similar exercises. The one with the amortization and straight line, there was a problem that you did for an exercise, and there was a problem that you did as a problem, and they were virtually the same. But if you notice, each and every problem that we have here in this problem section is different. All right, I mean, it's still based upon the same fundamental concepts, but the way the information is being presented and how it's being asked is different. Okay. So I'm not going to keep on going back over theory as it applies to the situation at hand. You have to understand the theory, go back and watch the videos. It reminds me of a student the other night that was in, and I think I mentioned this in the previous video, where the student was working on financial management. And in the financial management, the exam question was a basic bond question. It was just presented differently, right? And the student already had bonds in math for business and finance, so you can go back there and watch those videos. Bonds are covered thoroughly here in financial accounting, and I believe one other subject they covered bonds, and then here the student is in the 4th semester not knowing how to do a basic bond calculation. All right, so get the theory down. Because the application of it, the situations are different, but it's all based upon the same theory. All right, so with that said, my rant and rave for this morning. 4-49, excuse me, and before I get started here, just realize that I am going to pause the video and erase information. So just be aware that that's going to happen as I work the problem, because I only have this space on the right-hand side to work it. All right, so analyzing bond terms and accounting for bonds. All right, on January 1st, the Meadows Golf Course issued a $450,000, 15 years, 6% bond payable. The bonds were sold for $477. Bonds pay interest each June 30th and December 31st. So on a timeline, this is January 1st when the bonds are issued, right? And it's a $450,000 bond at 15% for 15 years. 6% for 15 years. Okay, so this is like 15 years. So at the end of the year, 12/31, it pays the interest on 6/30 and 12/31, so twice a year, semi-annual. So that means over the course of 15 years, there's 2 payments a year. That means there's going to be 30 payments of interest over the life of that bond. Now notice that's everything I picked up just by reading this portion here. I didn't, this is all understanding the structure of the bond itself. So the bonds were sold for $477. So if I have $450,000 as the issuance, and they're sold for $477. They're being sold for $27,000 more as a premium. Okay, because I'm getting more than the $450,000. Right? The bonds pay interest each June 30th and 31st, and any discount or premium is amortized using straight line. So we're going to have to amortize this $27,000 premium. Right, fill in the blanks to complete the statements. The Meadows Golf Course bonds are priced at, express the price as a percentage. Okay, so the bonds are priced at $477,000. Okay, but it says express it as a percentage, right? Well, if the bond par is $450,000, right? We divide the $450,000 into the 477, and that gives us 106%. Okay, so that is just basic math. This is something that you learned back in Math for Business and Finance in like chapter 2 or 3. Okay, if you didn't get that, understanding how to convert that into a percent, go on the community under the Math for Business / application section, and there's, like I said, there's videos in chapter 2 or 3 on basic percentages, or go back to your Math for Business and Finance textbook and pick that up. Right. When the Meadows Golf Course issued its bonds, the bond interest rate was higher than, lower than, or equal to 6%. Okay. The market interest rate, the market interest rate is lower than 6%. Okay, so I paused the video. That's why it seemed like to be a glitch in the video here. I paused the video because I had written down lower than, but I stopped the video because I had to think about how to explain this. All right. If at first glance you read this and it says when Meadows Golf Course issued its bonds, right? So when it's issuing its bond, it says 6% here. Okay. The market interest rate was, and then it's giving you a choice, higher than, lower than, or equal to. And so you're figuring out is it one of those three to the 6%. And at first glance, you're going to look and say, okay, this says 6% here, and this says 6% here. But yet I wrote the answer down as lower than, okay? And that's what the answer in the solution manual has, is lower than. If you put equal to, because you're looking and saying, oh, 6% and 6% on at first glance, okay, you're not thinking. You're not thinking through the concept. The bond is issued at par, all right, at 6%, okay? But the market rate you have to take into consideration that you're getting this here premium of $27,000 on that bond. And when you amortize that, right, that lowers the effective interest rate, all right? So you're not getting the full 6% because you're amortizing that $27,000. So your interest rate at market value, which is where you're selling the bond for $477,000, that interest rate is less than 6% because you're amortizing that premium. Okay, you're getting the premium up front, all right, which makes your effective interest rate lower over the course of the bond itself. And if you don't understand the math behind that, go back and watch the theory videos. Okay, you'll see. And as a matter of fact, I think yeah, we're going to do let's see here. So payment of interest and amortization. Okay, so in B, we're going to do the math for this particular bond, but realize that we're calculating we're calculating the interest at 6%, the interest expense at 6%, that's what's being paid on the coupon, okay? But then we're, because of the premium, we're taking away the amortization of this premium. So what we pay out in cash, and I'm just going to quickly do some math here in my head. All right, actually I should just look at the solution. It says the interest is going to be $13,500, okay, and that's at 6%, okay, that's par, all right, but when we take away the premium itself, the amortization of the premium, our interest expense is $12,600, which is less than the $13,500. So now that's where that's coming from, okay? I hope that made sense. If it didn't, one, watch, obviously see me work out B here in order to do the math, but two, go back to the theory videos on, the theory behind the discounts and the premiums, and hopefully you'll understand that, that it's lower than the market value is lower than the par value interest rate of 6%. And if you still have any additional questions, feel free to give a call to an instructor. Yeah, I paused. I'm spending a lot of time on this because I know that something like that is very easy for someone to just go, okay, 6%, and as I read it, issued the bonds, and I read 6%, and I think it's equal to 6%, and bam, you get it wrong because you're not thinking through the entire concept of the bond, okay? But if you do think through the entire concept of the bond, you're taking into consideration the premium, which makes the market rate, the effective rate, less than 6%, okay? Right, so C, the amount of the bond discount or premium is the $27,000, which we calculated. All right, so record the following transactions. All right, so we're issuing the bond, so we're right here on 1/1. So we're issuing the bond payable on January 1st. Explanations are not required. This should be relatively easy since you've did this in other exercises and problems. So we're going to debit cash for the $477 because that's what we're getting, and then we're going to credit what we're going to owe 15 years from now, which is the bond payable of $450,000, and the difference between the two, debits have to equal credits, so that's the premium on the bond payable of $27,000. Right, B, payment of interest and amortization of discount or premium, if any, on the June 30th transaction. So now we're up to June 30th, and this here is a full 6 months. So on June 30th, the first thing we have to take into consideration is what are we actually paying out in interest. So we're going to credit our cash because we're going to pay interest. And our interest calculation, I'll do it down here, all right, is the $450,000 because that's the coupon on the bond, times the 6% times 6 over 12, and that gives me $13,500. Okay, so we're going to credit our cash for $13,500 because that's what we're going to pay out. Now, that means we're going to debit interest expense, but we can't calculate the interest expense just yet because we have to take into consideration the premium, right? So we're going to debit the premium on the bond payable, okay? And the premium on the bond payable, since the premium is $27,000 and it's over 30 payments, okay? And to amortize it as straight line, right? That gives us 27,000 divided by 30 is $900. So I have $900 as the premium on the bond payable. And since debits have to equal credits, I can back into the amount of the interest expense. So I have a credit of $13,500 and I have a debit of 900, so I'm going to subtract the 900, and I end up with $12,600, okay, as that portion, as the interest expense for that journal entry. And again, this is going back to B here, being lower than, right? At 6%, let me do this in blue. At 6%, the interest is 13,500, okay? But that's not what the effective rate is. The effective rate is 12,600, which is lower than the 13,500. Okay, so that's where doing that math, that's where the math comes in order to, so that you can see that B is lower than. Okay. Okay, so let's see here. C. Payment of interest and amortization or discount premium on December 31st. So we're here. Okay, and again, this is an additional 6 months. Right? And notice that being the bond was purchased on 1/1, we don't have any accrual that we have to make. Okay, always keep that sort of like in the back of your mind, is that if it's not purchased on 1/1, it all depends upon the terms too. I mean, you can, let's say as an example, you can buy a, let's say the bond is issued on September 30th, okay, right here. But instead of having a 6-month, a payment of interest, if it was 6 months, right, then your next interest payment would be March 31st. And so on 12/31, you'd have to make an accrual. However, if the terms of the bond were to say, okay, the payments are quarterly, right, instead of semi-annual, instead of every 6 months, they're every 3 months, right, quarterly, months S, right, well then, right here is a 3-month period, and you would not have an accrual, all right? If it was a 6-month, you'd have an accrual. If it's a 3-month, you don't. So I can't just say that all bonds on January 1st don't have any accrual, and any bonds issued in any other time other than January 1st do have an accrual. That's not the case. It all depends upon the terms of the bond. So you have to pay attention to that, okay? Right. But in this case, we don't have that, all right? So we're at December 31st, no accrual, and we have to pay the interest on this portion, okay? So when we go to pay the interest, we're going to pay the same amount, same calculation, $13,500. And yes, we're going to have to debit our interest expense, and we're going to have to debit our premium on the bond payable, and it's the same calculation, right? $900, and the interest expense is going to be the same amount, $12,600, because they're both for 6 months, and we don't have an accrual, so the entry is going to be the same for each and every interest payment over the course of 30 years. Right? So 3, at what amount will the Meadows Golf Course report the balance on its balance sheet at December 31st, 2014? Okay, so on the balance sheet, in the liability section, you're going to have your bond payable account, and that's going to be the $450,000 that it was issued at. Right? That's what you're going to owe 30 years down the road. All right? And then you're going to have your premium on the bond payable, which is going to be the $27,000, and we're looking at December 31st here. Okay, we're looking at December 31st here. So against that 27,000, we had, remember that's a credit, right? Which, let me do this in blue. We had this here credit on the bond payable, for the 27,000, but now we have to offset it by the debits for both payments. So you have the 27,000 less 900 less 900, and that gives us $25,200 as the balance in that account for the premium on bond payable. So that gives me the amount that I'm going to report on the balance sheet, which is going to be $475,200. Okay, so that's the amount that we're going to report for that bond on the balance sheet, and it consists of the bond payable and the premium on the bond payable. Okay, so I'm not going to go back over this again. Pause the video, watch it again if you have to. And definitely go back and watch the theory videos if you're not getting something. And if you still have a question after watching the videos, feel free to call and speak with an instructor. Okay.